Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. We're back in action this week and wading into the oil patch with my Jackson Hole ski buddy, who just happens to also run an energy trading CTA. Yep, it's Brent Belote of Cayler Capital. And after the mandatory chit-chat about ski and snow conditions, we get into how his models look at energy markets, whether greenflation is real, what happens dozens of years from now in oil if and when we're fully electrified as an economy, and how it's been for him hanging his own shingle and running a small hedge fund. Send it! This episode is brought to you by RCM, from clearing to execution, portfolio construction to outsourced fund ops, China to Nebraska. RCM has you covered for all things futures and derivatives. Learn more at rcmalts.com. And now back to the show. All right, everyone. We're here with Brent Belote. How are you, Brent?
Doing great.
Good. I had the pleasure of seeing Brent in person on the slope at Jackson Hole. Had his, what was she, 2? Is that your daughter or your son? I can't remember.
3, yeah, she's 3.
3 on a little leash. Leash is the wrong word. Harness.
Yeah, she's on a harness and she was skiing down. She's already off it, so she's in the right. She's off to the races on the ski team, ski
Yeah,
performance.
she was good. And you had all 3 kids, one in red, one in green, one in blue. It was a tight program you were running there.
You gotta keep them visible at all times, so it's good.
And then I was all ready for you to say, "Oh, you just missed it. The snow is terrible." Then it all came right after you left, but you said it's already terrible again.
It was great for about a week. We got about 4 feet of snow over the 10 days, and then the last 4 days it's been in low 40s with kind of rain and melting. So it's been a quick change and end of winter already.
And then we're recording this last week of Jan here, so you're going down to iConnections, go down to the warmth in Miami soon.
Yeah, excited. So I leave on Sunday down there for 4 nights. The conference just keeps getting bigger, and hopefully it's still as great as it was last year. So I'm looking forward to a busy schedule, and hopefully we can get some institutions. And looking forward to speaking on the RCM panel on Monday night at
That's right. We've had you on the pod a couple times before. Once when oil went negative, that was fun. Talking through that seems like 1,000 years ago. When was that? Like May of 20?
April 20th, 2020. So that was the day it went negative, and I think we did this the day after. So it would have been the 21st.
Yeah, 4/20/20 was the day it went negative. And then we had you back on, talk through the strategy. So we'll link to that, and people can go back there and hear all the ins and outs of what you're doing in the strategy. So I wanted to start and just talk through kind of how your thinking and strategy has changed over time. We've known you and been following you and had accounts with you, what now, for how long has it been? 4 years? 5 years?
Yeah, we've been running for 5 years now. So
5 years, yeah. So give us the what's the same, what's different over those 5 years?
Most is the same in terms of strategy wise, and what's changed is this last year in 23, we hired Sam Vogel to be our COO. So now it's not just myself, which is nice. So we're building out a little bit more of a team and a bench. We'll likely look to add one more to the employment this year, and we've passed over 50 million in AUM with kind of pretty quickly. So right now we're at just under 55 million AUM, and have been growing pretty steadily. So hopefully we can get close to 100 by the end of this year, if not sooner. So that's kind of the guys behind Miami, is to go down there and hit fundraising pretty hard.
What do those people need to work in Jackson Hole, or get to work in Jackson Hole, I should say? Or do you
They
go
can work
remote?
wherever they want. Sam's based out of Houston, and he has 2 young kids, so his was kind of a non-starter for moving.
Yeah.
I think good people over location is priority. If they want to come to Jackson Hole, even better. So, but it's not a priority.
And that doesn't make a good podcast. I wanted to be like, well, I used to go massively short 600% nat gas, and now I've scaled it back, and we only do this or that.
Yes,
But so the risk levels, everything's generally the same. The portfolio, how you look at it.
Yeah, everything's still been the same. We haven't changed any strategies over the last 5 years. We've launched a commingled vehicle on the Galaxy platform, so we do have kind of fund access, for lack of better words. I have noticed a change in the last, call it 2 years, in our investor base. We're seeing a lot more institutional fund of funds, and even kind of the multi-strats of the world have started looked at external allocation. So as we grow, I think that's kind of the next evolution of Cayler Capital, if you will.
Yeah, I think I've seen a little bit more of that too, of people looking and being more interested in discretionary and not even discretionary, but systematic and discretionary commodity traders.
Yeah.
So take us a step back. If it hasn't changed, then tell us how it's the same and give us
How's
the
the same? We're still
30,000 foot view of, yeah, of what you're doing for people who don't want to go listen to the old one.
Yeah, so we still run a systematic oil strategy. Our kind of two-pronged approach is we look at what does the supply demand look like over the next 6 to 12 weeks for each oil product. And then we have a quant overlay that looks at the physical markets, looking at the various basis markets in each one. We run about 70% of our VAR in relative value and 30% directional. So we do have exposure to long short oil, which has been good of late. And it's something that a lot of people have kind of been gravitated towards because our correlation to oil is fairly close to zero, just because we have the ability to get short and get long. When we do really well, I like to think of it as a event driven systematic. We do very well when events happen in the oil market that kind of push the physical market to a brink. Obviously, COVID 2020 was a great year for us, and 22 of Russia Ukraine was another great year for us, kind of when the physical markets had to kind of react to satisfy some of the oil flows that were necessitated around the world.
And what do you attribute that to? That the fundamentals align with your technicals and
Yeah,
basically
we,
everything's
we
rowing in the same
we
direction?
track over 1,000 different daily data points on the supply demand, and we're able to kind of see those or forecast them, I guess, fairly well. Like with COVID, we could see that we were filling oil storage globally. Demand hadn't caught up in terms of either bouncing back, and we could see that if we were kept filling up oil storage at this level, we would hit a point where we had to either cap it off or cut supply. And that's pretty much what happened when oil went negative, was they had to cap supply because oil storage was pretty much full at that point. And same with Russia, Ukraine. We saw oil flows still actually coming out of Russia at pretty good clips, and they were still getting on ships and finding a home. And we were able to see that, and it kind of called BS essentially on the $140 spike that we saw in oil. So we were long going into that, but we ended up exiting as a result of seeing those flows. The models caught a pretty good job of seeing that the physical market actually wasn't that tight.
And do you think of it more as like, hey, this is smarter access to oil prices, right? Of like, we should capture, if there's a big run up, we should capture some portion
Yeah.
of it.
Yeah, I mean
But
that's one thing with oil that I think people get a little wary of, is the geopolitical risk. But we've done a very good job of playing that over the last 5 years. We haven't had any down years in 5 years. And yeah, will you get caught off sides on certain days or certain weeks in relation to moves? Absolutely. But I don't think in the long run, we're catching the bigger moves for sure. And I think that, a good example was, we had a drawdown in the last 6 months of last year, and we were pretty much max short going into the weekend when Israel Hamas situation exploded, and oil was up pretty big, and all the products were up pretty big against that, and kind of took us out of a lot of our short positions in that. And I think the next day, on that Monday, I think we were down only about 80 basis points, but we missed a huge decline in oil as a result of that. And that happens sometimes. Sometimes the physical markets take you out, and it changes kind of the landscape of oil for the next 3 to 6 months.
but do you feel like your investors would rather you be almost a long flat profile? Like if you miss the big down move, so be it. Like we really want you to capture more if there's an
I,
up move.
I would say so. I would
Yeah.
say, I mean, I think that's probably a fair assumption, just from a standpoint of, if oil goes to 200, the S&P is going to take a hit. Your house is, there's going to be knock-on effects of $200, $300 oil if it gets there. And it's nice to have us as a kind of catalyst for that if we catch that on the way higher. So I would definitely agree with your comment.
Love it. And then, so over that 5 year period, what oil is basically flat, right?
Pretty much, yeah, yeah. It's kind of crazy to say, but yeah, it's pretty close
I'm
to it.
just gonna pull it up real quick. Yeah, I guess here in Yeah, in late 18, it was right about 65.
Yep.
Now we're about 75. So what we went,
Yeah, it's not too crazy, not too far off from that.
and what's that range when we were 65 to negative 20 to plus 140 back to 70.
Yeah, there's a lot of alpha
Woo.
and a lot of boost.
And you don't have gray hair yet. So good work. Good work. Yeah.
Yeah, it's coming. It's coming. My
Yeah.
kids are still young.
So changing subjects a little bit, and we'll come back to what's going on in oil, but talk. So those 5 years, right? You came out of a bank, you were a trader, you said, hey, I want to go do
Yeah.
my own thing, hang my own shingle. For any young people or old people or whoever listening who were thinking of maybe starting their own fund or something, what what was harder than you thought? What was easier than you thought? What lessons did you learn?
I think the lessons coming for me out of a bank was how to manage risk on a very micro level. We have a huge balance sheet at a bank and you're able to trade a little bit differently. We have VAR levels and we have set amounts, but I never thought of margin to equity or, what's my annualized volatility look like, or even drawdown for that matter. I had a hard finite number of drawdown in my, at JP Morgan, but say I was up $30 million on the year, my drawdown could have been 35 at that point and no one would care, right? Because they just care about the positive numbers on it. Whereas at Cayler Capital,
35%, you're saying?
what's that? No, 35 million. So like, they just think of it in terms of dollar numbers.
So if you're up 30 million and you draw down 35 million, like, all right, this guy's fine. He's only down 5 million.
Pretty much, yeah. Like, so that's,
Mm,
you're able to kind of, build a buffer that you're able to trade against.
yeah.
Whereas with Cayler Capital, we're constantly getting new accounts, monthly, quarterly, et cetera. And each one is essentially starting at zero. So your drawdown, if you have an account that started and you happen to be the high water mark, like for example, was last year, we were up, 20% through the first 6 months of the year. We had a couple accounts come in and then we subsequently, lost about 12. Now we still finished the year up on it, but those guys are kind of, longer term investors, which is nice. And they believe in what we do and how we do it. But timing is kind of everything with it, which is why with us, we run a higher volatility portfolio. And it's nice to have people who are in it for the longer term. Like we've made money every year, but we still have people that come in, will be in our program for 3 to 6 months, and then decide it's not for them and close, whether that's profitable or negative. It's different. So that was a big change was in terms of how I take risk and how I think about kind of the overall strategy.
Right. It wasn't just end this period with the as much money as you can.
Exactly,
Yeah.
exactly. You think of daily returns, daily VAR. You can't have, you think about like a big option portfolio, you can't have a day where you're down 15%, even if the next day you're up 25, because just the amount of volatility that it's spitting off is not palatable for 99% of the investor base. What took longer and what I kind of underplayed was I thought having a 10-year background in a bank would allow me to either come out and be able to raise seed capital on day one. And that was far from the case.
Yeah.
Pretty much people view a bank like
They don't trust it. Yeah.
yeah, they think that we just have so much information, so much systems. And at the bank, we call it seat value, where each trading house has each place you're sitting has a seat value, and that's something that you kind of have to get around that stigma. And so it really took me almost 2 or 3 years of track record before it happened. And then 2019 we came out and had a good year, but not a great year. 2020 was a good year. But then every call I'm having after that says, well, was this just a flash in the pan? Were you a
Yeah.
one-off? And so it really took 22 to validate that, hey, we're catching bull markets, we're catching bear markets, we've done this, and that's where I think like our next growth is coming. And now, crossing 50 million, which we have some investors that have capacity rights that will expire, and they said they're going to use them. And what that'll do is we're going to grow pretty substantially from there. So I think, I think just getting to that critical mass standpoint is kind of where we're at.
And it's almost the one thing leads into another there with the bank, right? Like I think people might not trust track record because they know that you didn't have the same risk profile and
For
it
sure.
was just about making money. It wasn't about the path of how you make that money.
And even then I had a great call with, a I would call it a multi-strat investor, and they said, like we like you, we like what you do, we like your returns, we like how you're thinking about the markets, but we need to see that you can manage big money outside of a bank.
Yeah.
Now, whether I had $100 million years at JP Morgan or whatnot, they want to see that we can manage Cayler Capital can manage 50, 100, 200 million to make it count, and they want to see that scalable. And it is an interesting thesis because it does change things when you're dealing with such large numbers. Like how do you mentally think about, how do you sleep at night knowing that if you have $300 million, if you have a 10% drawdown, you just lost $30 million. And the numbers
Yeah.
get big. And that's, again though, one of the advice I got from one of my bosses back at JP Morgan was, if you're going to lose early, because it teaches you learn a lot about yourself in your career when you have these big losses or drawdowns. And I think it's really true of how you bounce back from them. How do you mentally handle being down? Are you second guessing yourself? Are you conviction? Like, what's your conviction rate? So I think for us, being a systematic actually has really helped with that. It's helped me, keeps us on a strict guidelines of risk tolerance, keeps us on a strict guidelines of how we think about the market and where it's going. So it's definitely something that keeps us on the railroad tracks for sure.
I was going to say, how do you handle that? But by being systematic. But right, in theory, in the math of it, the systematic part of it does. I'm doing 30 contracts. I'm doing 300 contracts.
Yeah,
It shouldn't matter, right?
yeah. I mean, our program is scalable easily to $500-600 billion. It's more a function of how much infrastructure do we want to build out, and where do we want to go with it. As you grow, you need more people. As you get to bring on larger LPs, they will request additional, whether it's chief risk officer, whether it's
Yeah.
a legal vehicle that we have to house ourselves. So there's a lot of kind of nuances to growing, and that's what we're trying to do right now, is just grow smart. We want to grow consistent. We want to grow, during returns we can show that we can make money during this time and lose money during this time, and that it's still the same program, whether it's 30 million, 50 million, 500 million. And so that's kind of where we're at right now.
So the harder part is you can't just blow through 30 million and everyone still goes out for a beer after work. What the easier part, there's got to be an easier part. What's the good part about going out on?
Oh, about going on my own?
Yeah.
I've always liked in trading that it's a very, it's a meritocracy. It's, if you make money, there's a scoreboard. And if you do if you make money, you get paid on it. And that's something that I've always liked in it. And also it's heavily scalable. Like you mentioned, whether it's 30 contracts or 300, the process and the way I think about it in the business is all relatively similar. So just being able to kind of build a business and have something that we've done, and kind of building a legacy of things that I've worked my whole life for, is something I really enjoy. So I really enjoyed kind of the entrepreneurial aspect of it, of building a business and finding different partnerships. And we're kind of at a point now where it's been really fun. We're starting to look at different partnerships, and possibly it might make sense to create a joint venture with another fund, or it might make sense to launch a multi-strat, or we're kind of hitting critical mass where we can start thinking about different avenues and different partnerships that are really exciting.
You missed the obvious answer, which is you get to live in a place like Jackson Hole.
Yeah, that is true. Well, that was my main thing, was when so back to the bank, my wife and I were living in New York in 2016. And in February, we found out we were pregnant with my first daughter, Cayler. And it was kind of a make or break where, okay, well, I'm from San Francisco, she's from LA. We both went to school in LA. We thought we were going to move back to LA. So it was, okay, well, what job can I get in LA? And there wasn't a ton of finance, especially in commodities. Commodities is very localized to, in New York, Chicago, Houston, and London. And it was kind of a situation where we'd either have to live in one of those three or four, or I could try to do this on my own and we could live in California. And as luck would have it, we got to California and turned around and came back to Wyoming. So it kind of worked out that way. But it was definitely something where I decided that I was going to give it 3 years to make it work. And if it didn't work, then I probably would have been back in either Houston, London, or New York.
And do you ever see if some pod shop or some energy group came calling and said, hey, we want to give you this huge check to come trade back inside the group, and you can do it remote?
There's a price for everything. And my answer is always, I had an offer to go to Houston last year, but it would have been Houston to be part of a larger team. But I want autonomy. I've ran my own company now for 5.5 years. I've built a good business.
Yeah, that's a tough drug
if you
to
want me to
kick.
come there, like I'll come build a business, but I want to be my own pod and I want to be able to bring and hire people and grow it. And I'm not leaving Wyoming. so,
Right.
so
Those are
those
my
are
terms.
usually at that point they say, like, okay, let's keep in touch. So
What are your thoughts? I don't know how deep you are in that world, but on some of those pod shops in particular and energy, right? There's been a few energy groups that have a trader in different electricity markets or different one oil trader, one gas trader. What are your thoughts on how those guys run a book and what they're doing?
I think what they do is great. I think it's kind of it's just the multi-strat model, and you're seeing that more so. There's not a lot of 5 billion-dollar commodity funds these days, and the reason behind that is it just makes more sense to go to these pods and go to these shops. Now if we lived in Houston or we lived in New York, I don't think I probably would have ended up jumping to one of those, but the autonomy of Jackson really made it a non-starter for us. And I think that's why a lot of these pod shops are ones that are now looking at external capital. And I think it's because they realize that hiring a guy like me, who it's easier to almost and cheaper for them to just give Cayler Capital money than to try to hire myself and my team away and give me the amount of capital that I would require and the amount of, I would say the initial sign on as well. They're like, well, we'd rather just give you money instead. So that's been where a lot of our interest in the last 6 to 9 months have come from, is some of these
Right. It's
guys
more
I
of
didn't
a
even know have external capital capabilities are calling us up asking if and we've had
more of
that.
a lease your performance versus buy it outright.
Yeah,
Um,
exactly. And especially when I say, like, when they hear my request of I'm not leaving Wyoming and and then
yeah,
and I want my own pod and autonomy, and then they go, so
yeah. And given there's all those guys and right there, what are they paying some of those guys to come out of those banks? Like millions?
it just depends. Like, it's interesting
Yeah.
because I've talked to a lot of my friends about this, and especially that we're still on Wall Street, and they're not really paying them huge sign-on bonuses. They're just buying out their existing equity that they have. So the way like our bank pay was we would get 2/3 2-year deferred and then 1/3 3-year deferred. So if you have like 3 good years of JP Morgan, Goldman Sachs, whatever, you're gonna end up with a very large chunk of equity that's kind of rolling off over the next 2 to 3 years. So most of these would end up in a situation where you have to make them whole. They won't just walk away from that because it's just too much. So a
Yeah,
lot of
yeah.
the large numbers you see when it says, Millennium pays this guy $20 million. It's like, yeah, but
He had 18 coming to him or
yeah, I
whatever.
had
Yeah.
18 coming to him over 3 years at Goldman Sachs, so they at least had to make him whole. And these
Um,
the
but
numbers,
still, they're still
the
paying
numbers,
it, right? They're
the
not
numbers
getting
are
it from
really
Goldman.
stacked. And
Yeah.
what's interesting is I had a call. I won't name names, but I've had calls with those people before, and I've told them, I said, listen, we're growing fast. Like Cayler Capital's at 50. If we get to 200, the number for me and to buy my team becomes exponential at that point.
Yeah.
And their response was, we would rather spend 10 times as much money to buy someone who's running a 200 or $250 fund than an emerging manager like yourself, sub 100.
Yeah.
I found that fascinating. They have so much money that they'd rather wait till you've made it than
Right.
do
Yeah.
these. So
Yeah. They probably know what they're doing there. Like it's
yeah.
not just
That
not
said,
worth
we
the
have
risk.
no plan to close Cayler Capital or return over money, and we're still fundraising. Life's good.
That's good. And then I think we've talked about it before and some other, but I'll just again for some of the younger people listeners out there, like how hard is it to get those seats, right? And to be successful in them at the banks, at these pod shops. I mean, one precludes the other, right? But
Yeah. I mean, really hard these days because
yeah, there's less of them.
there's less of them, and they're less risk oriented. Most of the banks these days think of their commodities traders as almost they're more market makers. They want to satisfy their clients because they make way more money on the financing and hedging operations and investment banking than they do on the commodity side and actually trading around it. So there's still some very large risk takers out there. Obviously, the largest is VTOL. And what's funny is when I left JP Morgan, I was in a final round interview with VTOL in Houston, and one of my good friends was the other one, and he got hired. And now like we joke about it, we still talk a lot, like 5 years down the road, and I'm like, man, I can't imagine my life if I got that over you and versus this. And I'm like, I'm so thankful you were better qualified for this,
Mm.
and did it just from a lifestyle perspective with Houston and time and kids and everything. So certain things kind of end up being a blessing in disguise, but those seats are very difficult and
And is
yeah,
it the right schools, the right connections,
I mean, yeah,
acing the interview, all of the above?
I don't even know what JP Morgan is now, but when I started, I got hired out of grad school and they were only hiring MBA interns from, I think it was like four. It was like NYU, Harvard, MIT, and I forget the other one. And then even their undergrad was even more stringent of like five or six.
Hmm.
And I don't know where they've kind of gone from there. And they had a whole piece where 2 years after 2008, they made a rule where they'll only hire if you were an intern. So you have to intern and then you transition. So, and that was when I came out, and I did my internship. I interned on the natural gas desk, and my boss at the time, Adam Soilemes, was like, "Listen, I want to hire you, but I don't need you in a year. I need you to start now." He's like, I can't like, the typical MBA at that time was you go to 1 year, you go intern, you get hired, and then you kind of piss
Finish.
off and screw
Yeah.
around for your entire second year of MBA, knowing that you have a great job,
Right,
9
right.
months ago. And he was like, no, I need you now. So it kind of changed my second year MBA a little bit, but I wouldn't change anything. I got such great exposure to different opportunities and
And do
being
you think
chartered.
whether you're in those seats or whether you're where you are now, like, is energy trading the hardest trading there is?
I don't know. I've never had much exposure to the other ones. I can't say that. I would say, I would say no. I think there's probably other ones out there that carry more nuance and more, but I think,
I'll rephrase, the most competitive there is, right? Because you have these huge shops,
yeah,
VTOL, all
I
the
don't know
banks,
because
the
you have
energy
that with
groups.
other things. Like if you're a rates
Yeah.
trader,
Yeah,
there's
true.
only so much. There's only so many. Like what makes commodity trading a little bit more manageable is the amount of money needed to start it. We're a $50 million, you know, essentially oil fund, oil program. How many $50 million credit funds do you find out there? How many
Yeah.
$50 million, rates? Like you just don't have those outside of some of these large, the blue crests that have 10, $15 billion of credit allocation. So it's a smaller sandbox when you get larger because you need more money for them. So it's I don't want to say it's the most difficult, but I would say it's probably one of the more accessible. And if I wasn't, I don't think I would have been able to go the CTA route.
Switch tax again here. So let's talk about oil in general, energy sector in general. Um, Kind of we touched on a little bit that 5 year range has been basically flat, but a lot of volatility in there. So wherever you want to start, but you want to start what we saw in 23, what kind of stood out to you the year gone by?
Yeah, I think what's interesting to me has been the knock-on effects of Russia Ukraine, even from 22. It created such a distillate, shortage globally that it was something that we were really focused on and chewing through over that entire year. And 23 saw similar, where distillate was kind of in the forefront. And I think that's why, if you look at some of the high returns that you've seen in it, I think that's why a lot of the natural gas guys had large natural gas funds did really well in 22 and 23. It was kind of a combo of a little bit of everything. Where we are currently, I think this year is really fascinating. OPEC still has a ton of spare capacity, but the fundamentals right now are very strong. Obviously, everything we're seeing in the Red Sea is bullish. And realistically, if OPEC didn't have the cuts they currently have on, and we were seeing what we're seeing right now, we'd probably be around $100 oil already.
Mm.
But because of the headwinds and that looming effect that's still there, I think they will put a cap on it. If we rally, I'd probably say we're at right around $80 Brent oil here. I think anywhere close to 85, 90, I think you'll see Saudi talk about releasing some of the cuts that they had to try to meet it. So, I do think that everything is looking pretty bullish, but the headwinds of just someone can turn the spigots on pretty quickly is going to put a cap on it. I'm not saying we can't get through there, but I just don't think it's a demand story that's going to back it to get to, you know, the high above 100 this year. So I sadly think that we probably will be um, fairly kind of range bound for oil, at least in the short term. Now gasoline and distillate are still fairly interesting, but the fact that now we got past the cold, I don't see any cold on the horizon really. It actually seems like winter's kind of warming up even here. So I'm curious if distillate, if we're just not going to have the heating degree days and demand to keep it kind of going.
And
But it's good.
explain distillate real quick for those who
Distillate
don't know.
is diesel fuel and also heating oil. So it's kind of a combo that you can use to refer to both of them. And jet fuel for those three. And so what you see is, you know, in the winter, obviously a lot of the East Coast still heats their home with heating oil. And then also is diesel demand as well. So you get a lot of demand from trucking and from kind of global macro upticks. And when you have really warm winters like this, it just allows you to build up stockpiles pretty quickly.
And so is that heavily tied in with refining?
Absolutely. Yeah. Yeah, exactly.
So what with Russia, Ukraine, and you said distillates spiked? That was
Yeah.
because the refined product wasn't coming out of there?
Exactly. And then in the last kind of couple of weeks, what we've seen is because of the cold weather that we had in the Gulf Coast and really all over the United States, I think they lost about 15% of the refining capacity in the Gulf Coast. So distillate and gasoline have been very strong over the last couple of weeks. Something that we've caught pretty well this month. I think this month we're up just a little over 2%. But it's been something that we've done very well on being long on those.
And so as oil trader, but your portfolio is more than just oil. So you trade all the distillate. So walk through all the products that you
Oil and
could
oil
have on.
products is the easiest way to think about it
Yeah.
for us. So the two primary ones are gasoline and distillate. So we trade, WTI, Brent, gasoline, and heating oil, and kind of every combo in there. And a gasoline to kind of bring it back up, a gasoline crack and a distillate crack is the amount of money you make by refining a product. So, right now, distillate cracks are around $30, which means that if you took a barrel of oil and say for some reason you had a magic oil refinery that only made 100% distillate, you'd make $30 by putting it through there. It's kind of like your margin on refining, for lack of better words.
And what's the overall, right? I'm harking back to California. It was like, we're not allowing any new, or the California Refiners Association wrote that letter of like, it takes us 10 years and $1 billion to plan out a refinery. And you're saying you're not going to have gas cars in 10 years. Like, why would we build a new refinery and increase refining product capacity?
California also kicks themselves in the junk even more by they have a special kind of gasoline called carbob, which is very expensive and difficult to make. So that's why, another reason why gasoline in California is expensive. And
so what is, yeah, go ahead.
Go ahead.
I was just gonna say, what, give us that outside of California, like the whole refining capacity, what does it look like?
In the United States, we have different PAD regions, is how we kind of break it down. I should know that acronym, and I definitely do, but it's definitely lost me at this point.
Yeah.
But PAD 1 is the Northeast, PAD 2 is Mid-Con, mostly Chicago. PAD 3 is the Gulf Coast, and then PAD 4 is more kind of Denver area in that whole kind of space. And then PAD 5 is California. And what's unique about California is there's really no oil, it's really difficult to get oil over there. There's no pipelines that kind of flow east to west. So actually they end up either importing a lot of their oil or their gasoline that they need from Asia. So it's kind of a unique island that PAD 5 is usually its own kind of microcosm, whereas PADs 1, 2, and 3 really drive the oil, the product markets.
And so excluding PAD 5, what does the refining look like in the rest of it? Are we building refining capacity, or is there this overhang of like, we're not going to need it in 50 years, we're all going electric?
And that's where, that's what everyone tracks is refineries are really complex, and you have to plan these outages like months in advance. And so most of the refineries will come out and say, okay, hey, we're going to go down for 6 weeks to clean this or redo this or fix this. And there's engineers, there's people, you got to plan for, you got to reconfigure your refinery to not run in that specific unit. So what we've tracked very closely is refinery turnarounds. And we track that on a unit level basis. So we look at each refinery unit, what goes into that refinery unit, and then what would come out of that. So how much
What's a
gas.
unit? Like the whole refinery, or like
Yeah,
what
so
they?
a
Yeah.
refinery is made up of 10 or 12 different units, and each
Okay.
one really does a different thing, whether
Hmm.
it's create more gasoline, whether it's kind of get to fuel oil, whether it's to blend it. They create each
And they
one has
can't
a different.
easily switch units back and
No,
forth.
they're very complex and very large and but it's a flow chart. And so
Yeah.
if one breaks, you can't just go around it. You can at time, but you
Right.
produce.
Or if, hey, jet fuel is way more profitable, let's switch over this.
Yeah. So they can do that to a certain extent, and that's exactly. There's petroleum engineering. That's their entire job, is trying to optimize the refinery for returns. So they'll if for some reason distillate cracks went to $60 and gasoline was 30, there's a wiggle room where you can change it a little bit and produce more distillate versus gasoline by putting in a different type of crude. So each crude, when you put into a refiner, actually produces a different uh, kind of distribution of products. So if you took one barrel of oil out of Midland and put it in an oil refinery, you'd get XYZ. Whereas if you take one heavy sour out of Mexico and put it through an oil refinery, it'd be a very different breakdown. So there's all this breakdown, and there's entire teams dedicated to buying the right amount of oil to try to
Hmm.
get that blend right. So you're in the sweet spot where you're kind of maximizing your profit.
And let's talk greenflation, where you stand on it, right? We touched on a little bit here, but is this move towards electric? Is this move towards everything's got to be green, more wind, more solar, more everything? Short term bullish for energies, long term bullish for
I
oil,
think
which
it's
doesn't
very
make sense.
long-term bullish for energy. And I think what you said is a great lead in, that why would I build an oil refinery that takes 10 years to recover the costs when you're telling us we're not going to need oil in 10 years? And you're seeing that across the whole energy space, whether it's even oil exploration in Texas, the Gulf Coast, wherever you're seeing this, oil demand is still increasing, and it likely will increase for the next decade, just global demand, that is. Yet future investment in supply is declining, and there's going to be a point where demand passes supply on the yearly basis, and that's going to spike oil very materially higher. And it's going to be a situation where they're not going to be able to turn it on, because typically, some people always say the best cure for high prices is high
High
prices.
price, right?
Yeah, and like, when does at $250 oil, all of a sudden people are exploring everywhere trying to find oil. But if you still have the belief that the government is either A, going to tax it out, or B, just legislate it out where you're not allowed to drill or take it away, why would you be involved, and why would you put money to work with something that you're not sure is going to be around in 10 years? So, I think you're in the sweet spot where this year, not so much, but I think probably by next summer, I think demand will have caught up to kind of the overhang. I think OPEC will have released their supply, and I think that'll start to be the turning point where demand will outpace the future supply growth that we've seen in the last 2 years.
And
Um,
that supply growth was still all COVID hangover.
no, the supply is going pretty good here in the United States. I forget, we outgrew last year pretty substantially. Mostly in Midland, but some North Dakota, kind of a little bit of all over, but the growth was still pretty strong. They're just getting more efficient, and the efficiency factors are getting really good at it. But there's a point where it's just not going to be there anymore. And even if you get more efficient, you're still not going to be able to kind of squeeze the barrel out of the ground even more, without massive infrastructure investment. And at $70 oil, and the fact
Yeah.
that your recovery time is not a 10-15 year PE project. It's now you're trying to squeeze all your returns into 5 years. On your DCF analysis, it's looking like, wow, we need XYZ $90 oil to break even, because we have to get all our money out of it in 5 years before you know, electric vehicles take over and the demand kind of craters. So it's
And
it's
do you know off the top of your head what those numbers look like? Like shale is what's its cost of production like, right?
I think the last I saw was low 60s.
Okay.
But again, it all
Versus
depends.
Saudis like 10 or something.
Saudis is irrelevant. Yeah,
Yeah.
5, 6.
Yeah.
Yeah.
Just, hey, here's some oil. Pick it up.
Yeah,
Yeah.
there's oil. Um,
And then how
yeah,
do you square all that with like as we talked about before, Saudis could just turn on the spigot whenever they want,
yeah,
but eventually that won't even be enough to outstrip demand, you're saying.
yeah. And also, I mean, the big thing you're thinking about with all these is is every well, if you're not either drilling more, is really declining. Like most the decline in rates on shale is massive. Meaning, I think it was something like it produces 90% of the total oil over the first 18 months. And then it's
Hmm.
just a steep decline curve out that. But which is why they were great because everyone wanted to invest in them because you're getting so
You
much
get it
money.
back right away. Yeah.
You get your money out fast, but then it decreases so fast. Now they've gotten better at kind of smoothing that and getting the long terms out there, but it's still a situation where if you want to get long-term investment into the oil space, I think it's really hard.
From a infrastructure standpoint.
From an infrastructure, from a cap raise, I mean, even at where we're at now, rates, with rates where they are, getting funding for these longer term oil projects is just getting really expensive.
Yeah. And then you also have the like social pressure, right? Like if you're Harvard or some of these schools you mentioned, like, hey, we're going to take the endowment money and invest in oil exploration. People are like, what? You crazy?
Yeah.
Uh, you're not allowed to do that with our school's money.
Yeah, exactly. You're seeing that a lot where the fossil fuels are kind of out, but it's a weird scenario because you're gonna need it. And
Right.
even
But eventually in theory, eventually that curve switches, right?
yeah,
So
eventually that curve switches where demand is below and supply, demand decreases. And will we push oil lower? Yes. Will gasoline be cheap? Sure. And there'll be some byproducts that come out of it. But you've seen that with natural gas. Like, natural gas has been from $15 down to 2 to a byproduct. And
yeah.
then it's had its day in the sun. And natural gas hedge funds are thriving. And we've basically been in a kind of a short-term range for the last decade and they've done very well. So it's really a unique scenario.
But do you think like 50 years out, whatever that number is, some long term out, right? And everyone's wildest dreams come true, and we're solar and wind and everything, and all electric vehicles, and
Yeah,
what happens to oil? But there's still oil in the ground.
still going
Is
to
it?
need oil. You're still going to need it. It's one of plastics, chemicals.
Yeah.
There's still a lot of things that come out of an oil refinery that are needed. Now, will gasoline be a byproduct? Maybe. And maybe they'll find a way to kind of use the ones that they need and get rid of the other ones. But if there's one thing I know, I mean, if you look at a lithium mine and then you look
Yeah.
at another refinery, which one looks worse for the environment?
Yeah.
And then you look at our power grid and you can do it it'll take anyone 10 seconds to Google it and figure out how much electricity we would need to, actually power every car and get it going. And it's the grid just infrastructure just isn't there. Now, 20 years from now, maybe with the amount of investment that they could do, but it's just not there. And that's where I just don't see, you know, globally it becoming an issue where it's going to be something along those lines.
Right.
For
And it's not for your 10-year plan personally, and for Cayler Capital, like there's still a trade here for at least 10, 20, 30 years.
and even then, I think it's a
Yeah.
situation where, I think if say we get to that point 20 years from now, I still think oil is going to be interesting. It's just a function of what product will we be trading? Would it be something
Right.
where maybe we add plastics in the mix and now we're trading plastics because it's
Mm.
the sexy part of the only part that they want, propane. There's all these different kind of aspects that you can be a part of and get out. So I mean, we're trading a very small sliver of the oil barrel, and we could expand that pretty substantially if we needed to or wanted to.
You could shift to electricity, really go crazy.
Always power trades.
Yeah. All right. What else? What else you got on that regard? Anything?
No, I think I think we solved the world.
We solved the world's problems, right?
Yeah.
Hey, we're gonna need the oil. We're gonna need plastic.
I do think this is a very interesting year because of the headwind of OPEC and also the fact that it's an election year. The last thing the Biden administration wants is Donald Trump getting on a podium and harping on him about $7 gasoline. So they're going to do everything in their power to try to keep this under wraps, in the Red Sea. So I mean, I'm a
Hmm.
long-term bull, but I'm kind of short-term agnostic, I'd say.
And what we were speaking of Biden, all the SPR release, all that mumbo jumbo, was that politics? Was that needed?
It's always politics. Yeah, everything
Yeah.
in the SDR is politics.
Have they refilled it? What's the status
I
of it?
think they started to. Yeah, I think they're still in the process of doing it.
It seems like you could trade around that, no? Like they kind of
It's not
telegraph it, then they say
yeah,
where
it's
they want to
great to
buy
say
it,
it
but they
doesn't
probably don't.
it doesn't move the needle substantially on the global oil,
Hmm.
anymore, overall on it. So when he did it the first time, it did a little bit, but in the long run, it doesn't have much effect.
And then Russia, Ukraine is still going on, which
Still going on, but
a lot
everyone's
of us forget. But I guess, are you saying it was a non-event? Like the oil kept coming
yeah,
out of
China
there?
and India are basically buying almost 100% of Russian oil, and they basically said we don't care, and they
Yeah.
get it for cheap, and it's boosting their economies, and they're seeing, hey, we get oil at a 40% discount or 30, whatever it is that they're buying it at. So they just don't care. And Iran's out here doing their stuff in the Red Sea, and yes, we have sanctions on them, but they're still producing almost their max oil. So the sanctions aren't really helping either. And again, that's something where India and China are just saying, yeah, we'll buy it. It's good. Send it over.
Yeah. And what does that look like? Like there's the sanctions, and those are members of the UN supposedly, but there's ways they skirt it all.
Yeah, I'm not sure the logistics of it, but I think just kind of basically say no, we're not going to adhere
No,
to.
we're buying it from Glencore. It's all
Yeah,
good. Right.
yeah.
Awesome. Well, I'm sorry to miss you down in Miami, but we saw you in Wyoming. But
Yes.
have fun and good luck on the panel. You'll do great.
Thank you.
And we'll talk to you soon.
Thanks, Jeff.
All right. Okay, that's it for the pod. Thanks to Brent. Thanks to RCM for their support. Thanks to Jeff Berger for producing. We'll be back next week talking logistics with the CEO of trucking company Roadrunner. So go ahead and subscribe so you get it right when it drops. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.